In 2009, at the absolute bottom of the worst financial crisis since the Great Depression, Warren Buffett deployed $5 billion into Goldman Sachs. Not because he thought the crisis was over, not because he had some insider information that the recovery was coming, but because, in his own words, he was being greedy when others were fearful. That single investment returned billions. In 2020, when COVID crashed markets 34% in 33 days, the fastest crash in market history, the wealthiest Americans didn't panic sell. They bought Amazon, Apple, tech stocks broadly. While retail investors were liquidating their 401ks in a panic, wealthy investors were quietly loading up on assets at the biggest discount in a decade. 2 years later, those assets had doubled. And this is not a coincidence. This is a pattern that has repeated itself through every single recession in modern economic history. Recessions make a small group of people significantly wealthier, and it has nothing to do with luck, insider information, or starting with more money than everyone else. It has everything to do with behavior. And behavior is something anyone can change. So today I'm going to tell you exactly what rich people do differently during recessions, and more importantly, what you can actually do about it. The first thing to understand is that wealthy people have a completely different relationship with fear than the average investor, and this is not because they are braver or more emotionally stable. It's because they have studied enough financial history to know something that the average person hasn't internalized yet. Recessions are temporary. Assets are permanent. Every single recession in American history, all 12 of them since World War II, has ended. The average recession lasts about 10 months. The average recovery that follows is measured in years, sometimes decades. And every single time, the assets that were available at a discount during the downturn, stocks, real estate, businesses, recovered and went on to reach new highs. The people who got rich during recessions were not the ones who predicted the bottom. Nobody can predict the bottom. They were the ones who kept buying on the way down, accepted that they would look foolish for a while, and waited. Because they knew that time was on their side as long as they didn't sell. The average retail investor does the exact opposite. They sell when prices fall because falling prices feel like danger. They wait on the sidelines until confidence returns. And by the time confidence returns, prices have already recovered, and they've missed the entire opportunity. This behavioral gap between what wealthy investors do and what average investors do during downturns is the primary reason why recessions transfer wealth upward. Not tax policy, not rigged systems, behavior. Now here's the specific playbook, and I want to be clear, this is not financial advice. This is a framework for thinking about how the people who consistently build wealth during downturns actually approach them. Step 1. They protect cash flow first, before anything else. Before thinking about buying opportunities, before positioning for recovery, wealthy investors in a recession make absolutely sure their income is stable and their expenses are covered. They cut unnecessary costs. They reduce debt with variable interest rates. They build or maintain a cash buffer. Because the worst possible position in a recession is being forced to sell assets at exactly the wrong time because you need the cash. Cash flow protection is not exciting. It is the foundation everything else is built on. Step 2. They separate their emergency fund from their investment capital. The average person, when markets fall, liquidates investments to feel safe. Wealthy investors never do this because they already have cash set aside specifically for emergencies, completely separate from their investment portfolio. So when markets fall, they are not tempted or forced to sell. The emergency fund is the firewall between fear and irrational decision-making. Step 3. They buy assets that are on sale. This is the part everyone focuses on and almost nobody actually does. Because buying when prices are falling is psychologically brutal. Every headline is screaming about collapse. Every conversation is about how much worse it's going to get. And against that backdrop, the wealthy investor is quietly, methodically, without drama, deploying capital into assets they wanted to own anyway, just at lower prices. They are not trying to time the bottom. They are not betting everything on a single moment. They are simply continuing to buy quality assets consistently, in smaller amounts, at regular intervals, through the fear, because they know that the average price they pay over the downturn will be lower than the price they would have paid before it started. This is called dollar cost, averaging in a downturn. And historically, it has been one of the most reliable wealth-building strategies in existence. Not because it is clever, because it is consistent. Step 4. They look for asymmetric opportunities. Recessions don't hurt everything equally. Some sectors get crushed, others barely move. And a handful, historically consumer staples, healthcare, certain utilities, and companies with strong cash flows and low debt, actually become more dominant coming out of a recession because their weaker competitors didn't survive. Wealthy investors study which businesses benefit from or are insulated from economic downturns and shift their attention toward those. Not because they're abandoning their long-term strategy, because they're refining it based on the specific conditions in front of them. Step 5, and this is the one that separates the people who build real wealth from the people who just survive the downturn. They invest in themselves. Recessions are when the distance between skilled and unskilled workers widens most dramatically. Companies cut the people they can afford to cut. They keep, and often promote, the people they cannot afford to lose. The single highest returning investment available to most people during a downturn is becoming so valuable in their specific field that the question of whether they will be affected by layoffs simply does not apply to them. Every course completed, every skill added, every certification earned, every relationship built during a recession compounds for years afterward. The people who come out of downturns in a materially stronger position than when they went in are almost always the ones who used the slower periods to build something that cannot be taken away. Now, I want to address the obvious objection, which is, this is easy to say if you already have money. If you're already wealthy, of course you can buy assets on sale. But what about the majority of people who are living paycheck to paycheck and have nothing left over to invest? And it's a fair point. The playbook I just described is harder to execute with a tighter budget. But the principles don't change. Protecting cash flow first. Building any buffer you can, even small amounts. Avoiding panic-driven decisions. Not selling what you have simply because prices are falling. And investing in your skills and your earning potential, which costs time more than money. The gap between how wealthy people behave in recessions and how average people behave is not entirely about capital. A lot of it is about knowledge, framework, and emotional control. And those are things that don't require a large bank account. The recession of 2026 is either already here or arriving shortly. The oil shock is real. The inflation risk is real. The consumer stress is real. And the history is clear. This downturn, like everyone before it, will transfer wealth from the people who react emotionally to the people who respond strategically. The question is which group you're in. And that question is answered not by your current net worth. It's answered by what you do in the next 12 months. So I want to hear from you. Do you think, A, building wealth during a recession is genuinely available to ordinary people with the right approach? B, the system is structured in a way that recessions almost always benefit the already wealthy, regardless of behavior? Or C, the most realistic move for most people right now is just survival, protecting what they have rather than trying to grow it? Drop your answer in the comments, because I think this one is going to genuinely split people.